Welcome to Monday, January 27th for Now, Next, Later. As you can see, this episode is Robbie and Jeremy. Sasha is on site at the MBA's IMB conference and couldn't join us. Lots to do there. Robbie's also on site at the MBA's IMB conference, but could join us. So we're going to use today's Now, Next, Later, a little bit of a different format because we want, I guess, boots on the ground works on lots of levels when you're in Texas because it's actually boots on the ground, where most often it's just a metaphor. But in Texas, boots on the ground is literal.
I guess if both Sasha and I are on site, but Sasha has a lot to do, that insinuates I don't have a lot to do. It's a good guess. I mean, it's kind of true. Happy
I
to be.
didn't I didn't mean to imply that, but I did mean to imply that you prioritize the show, which we appreciate since Chrisman Commentary is the title and host and platform that makes it possible. The sponsor for today is Silk Title Company. So
Yeah.
thank you, Silk Title, for
We
sponsoring
also,
Now, Next,
I
Later.
was gonna say we also appreciate Silk Title, so that's good. It's a good
That's
segue.
right. So Chrisman Commentary and Silk Title bringing us Robbie live from Austin, Texas. Even if you didn't know the IMB conference was in Texas, you could guess from Robbie's tie. The bolo tie, I think, only comes out when Robbie's in Texas, but maybe I'm wrong. You tell me, is it also a New Mexico, Arizona thing or just
I got
Texas?
it as I got it for I was a groomsman in a friend's bachelor or a groomsman in a friend's wedding this summer. We met in Texas. He's from Colorado, or the wedding was in Colorado. Sorry, I'm speechless. I'm getting discerning looks from the Chrisman patriarch here. Uh,
It's a cameo,
I have not
big
worn
time.
this outside of the wedding. I thought it would be a good excuse to wear it, and I want your thoughts on if a bolo tie is now next or later, or if it's past and obsolete by this point. Audience, let me
No,
know.
I
How do we
my
feel?
my personal opinion, I'll check the chat in case anybody chimes in. I think it's one of those things that was uh, and is now coming back. So I think it's just fine.
Dude, now I like that. No, Matt Hackett says never. Oh,
Never, and then we
you
have a
don't
solid
like
now. So
it.
this is great. We have a good start here. No, I like it. We like audience participation. One of the things we try to do is put your questions in the chat because we definitely try to monitor and honor that. One of the things I wanted to start with about this conference, particularly in the Now, Next, Later theme, the way we often host the show, is there wasn't an IMB conference. As far as many of us growing up in the industry, it wasn't a distinction that warranted its own event. And a few years ago, enough market share shifted. The MBA decided this is a population that has dedicated topics, dedicated focus and attention. From your perspective, Robbie, let's just start with that as a premise. What makes this conference different and why IMB's getting their own thing?
I'm he's gonna hate this. I'm gonna call a lifeline for question one. You talk about the history
Cameo.
of IMB. Why did they make this an actual its own?
Why do they need their own conference, Rob?
You mean versus, well, I would say the IMB, the independent mortgage banks out there do face a certain number of different challenges than, say, the brokers or the bank-owned mortgage companies or the credit unions, and not the least of which is, having to have a warehouse line. And a lot of these independent mortgage banks are multi-state, whereas say if you're a credit union or a bank, yeah, I mean, we hear about the Wells Fargos and the cities and the Chases and so forth, but a lot of banks or regional or community banks are just in one state. A lot of these IMBs lend across state lines, across multiple states, and so they tend to have a different perspective in terms of the regulatory environment. And then lastly, I would say this is going to sound a little bit um, harsh, but I think the Mortgage Bankers Association had a somewhat of a void to fill in their conference schedule, and I think they can make a little money. You didn't hear that here though. Boy, I'll never be asked back. So anyway, I would say those are the primary reasons. Just kind of a slightly different set of lending issues than say a bank or a credit union.
Yeah, I think the idea that this particular business model has popped up and grown to such a degree I think is also indicative of the AUS, right? The GSE AUS, Robbie. So we're really talking about, sales and marketing on top of what is otherwise, pretty standardized, commoditized market. So my understanding is the conference started today, but also may not really kick off until later today. So what's been the first, so doing the now part, IMBs need their own space. They've got all these pressures. They have their own unique business model. What's so far look like or feel like on site with these IMBs?
I am blurring my background so you can see we are here live at check-in. We are
Okay.
at
A
check-in
little
hall.
empty.
I'm gonna count the number of people you see here. Yeah.
Yeah.
This is
Not
what's
many.
going on. There's one.
Waving.
People from MBA, and I gotta tell you,
Is that
they have guava lemonade over at the check-in station along with Reese's Bites. Phenomenal.
we didn't realize we were doing a JW Marriott commercial here, but guava lemonade at the JW Marriott.
Guava
Check it
lemonade
out.
from MBA. Or Escobar specifically wanted it. I don't know. It doesn't start until noon. People are already down in the lobby, at the lobby bar, claiming their tables.
Mhm.
People are awkwardly sitting at the bar, kind of like looking around, like, oh, do I
Hoping for
was gonna
familiar
wait
face.
for
Mhm.
a familiar face? It's reminds me of why I used to not come to these things, but we're excited. We've already had 3 or 4 meetings this morning, and companies are happy to be here. I remember being at the IMB a year ago in New Orleans, and you and I actually spent some time together there.
Yep.
Been the first time we met face to face.
I don't think so. I think we
I
met
mean, we like
in
talked
New
before
York
and
at
stuff,
one of the
but-
secondary ones. But
Oh, that's right. That would have been the second time. And
yeah,
the mood there was much more dour. And maybe that's just uh, a Marriott, standard Marriott in New Orleans versus a JW Marriott in Austin. There's different. They have better LED bulbs here or something, but the mood's a little more upbeat. The
than
people
last year. Yeah.
people are excited for what's going on. It seems like there's I don't want to say cautious optimism in the industry, but there's certainly a kind of like back to business as usual. How do we grind it out versus being like, are we going to survive?
Yeah. So on that question, is this the type of thing where you come in thinking of a couple of assumptions about either the market or IMBs that you're then looking to test when you talk to people, listen to those conversations, hear the sessions, hear the hallway talk, or are you going in totally open-minded and you're like, what do we got here?
Jeremy,
what's your
we're very different men. You think I go into these things with assumptions I'm trying to test? I'm here to get some cold hard sponsor dollars so we can continue to thank companies like Silk Title for being a part of what we're doing.
fair enough. I
Also,
appreciate that.
forge new relationships, get a pulse of things, kind
Mhm.
of get the chatter of what's going on. I'm gonna flip that on to you real quick. If you were here, or maybe we'll get you a sponsor for the next conference to get you actually
Excellent.
out there.
Sure.
What are your assumptions that you'd be testing?
The two things I've been thinking a lot about are servicer retention of refis. So we know that there's a lot of uncertainty whether there will be interest rate, either volatility, fluctuating, or specifically will interest rates decrease in any meaningful way in the next 6 to 8 months. And I believe that if they do, there's a lot of people, especially in the IMB distributed retail space, who are confident those cash out refis and other types of refis will come to them since they just did the purchase within the last 3 years. I'm wondering if that's true. So the thesis that I'm testing is we heard a lot about big servicer platform retention. How real is that threat? Because talk to different people, you'll hear different answers on how real that threat is. And so one of the assumptions I would be testing is that a real threat? And if it is, what are we supposed to tell these IMBs?
So I was actually here in Austin a week ago with my dad speaking at a UFCU credit union event. And we like to do a little poll wherever we go. We say, audience, you have 3 options. Raise your hand for one of them. A year from now, rates will be higher, the same, or lower.
Mhm.
A year ago, everybody thought they're going to be lower. Now most people think they're going to be the same in about a year. But that poll is about as good of a rate prediction survey that as exists out there in the world. For anybody to say, oh, I can give you meaningful reason that rates will or I can give you reason that rates will come down meaningfully in the next 6 to 8 weeks. Respectfully, you don't know. So
Sure. So then think about this.
Okay, go on.
think about this. I'm an
Before I get
IMB
too
CEO
passionate.
traveling. I'm an IMB CEO traveling to Austin, and I have a budget cycle that requires that I figure out something to allocate toward cost, and I'm including the expense of payroll in that. And then what are my projections for revenue, right? So how am I supposed to set up a budget in November of 2024 that let's say I base that on $1.5 trillion
Well, I think the
market,
prudent thing,
and
and
then
actually,
and then I can't handle the volume and I miss out, or I base it on a $2.2 trillion market and then I'm overstaffed and it
Jeremy,
doesn't happen. So
let me give you a little financial modeling 101 here today. Okay. And I went to school in this town at the University of Texas at Austin, the McCombs
I
Business School,
figured it would come up. I
where
assumed it
they
would come up.
where they did the only reason I haven't gotten an MBA is because they did a very practical education, a lot of case studies, a lot of things like that that I think normally exist in MBA programs. Every single analysis we would do, you did best case, most likely, worst case scenario. And I don't know why my answer to you for this question you're saying, mortgage companies should be doing the exact same thing. Test a scenario where originations this year are 1.1 trillion, test a scenario where they're 1.6, and test them where they're above $2 trillion. And make sure you're profitable in all three of those scenarios. I'm sorry for kind of poo-pooing the question there, but I don't know why companies aren't, that seems like what I was taught to do.
Not at all. I don't think that was a challenge to me as much as it was a challenge to IMB CEOs. And we hear a lot about staffing. One of the topics that comes up quite a bit is, hey, I spent money on technology. Why are my costs going up instead of down? And a theme that Now Next Leader has identified is trust in technology. If I buy the technology because I'm told to, I think it's going to lower costs, but I don't adjust the rest of the scenarios, then I've only actually increased my cost with now people and technology. Now, everyone who watches the show has heard that plenty of times. It's a consistent theme here. So really the question comes down to what, if anything, is going to change in 2025, either as a result of trends, as a result of the groupthink of the mortgage market. And if the answer is nothing, that's okay. Because I mean, the Jeff Bezos model of like, it's better to rely on what isn't going to change rather than what is going to change is a sufficient rubric. It's a sufficient framework. But we have a lot of people on this show that are technology companies, vendors, and service providers to lenders. And so they're trying to figure out how to talk to the folks making that good, better, best type of scenario, or in your case, like good, middle of the road, worst. And if they're trying to talk to those folks and those folks aren't doing the modeling, then I think it's better to assume nothing's going to change from both a rate environment and an IMB behavior environment. But these people have to decide how to address that, particularly in the conversations they're about to have in the next couple of days. So I think that's what makes it fun, but that's the question.
I would not be I would not be under the assumption that things are going to be that much better than last year. That's kind of how I would approach things.
Yeah,
But
flat year.
I remember saying this in a call I had the other week. We're talking about how companies can reduce expenses or how they can continue to scale both up and down depending on volume. And the comment that I made was, I think this market cycle, this extreme market cycle we've been in, the best of times, was Charles Dickens. It was the best of times.
At times it was the worst of times.
Exactly.
Opening of Tale of Two Cities.
It's taught companies how to scale in ways that they will never forget. I think that's been the best thing that's come out of this market cycle, both to scale up and to scale down, to convert expenses from fixed to variable, those sorts of things. I think companies have learned a lot of lessons there, and it's going to benefit the industry going forward. I do.
So let's talk going forward. I'm learning these lessons.
So the next?
Yeah, exactly. What's next? I'm learning these lessons. I'm applying them to my business. I'm taking a very neutral, conservative approach to next year, this coming year, next year. And I think one of the things for this IMB conference is, what do they need to know? So if I'm an IMB CEO, I'm coming to hear MBA leadership certainly talk about the regulatory environment, DC, what may or may not change at the GSEs. I have an opinion on that. Is that the only / biggest thing that IMBs need to care about in this coming year, given that we're going to control for everything else the way we just described? What do you think is the hottest topic either
Well,
so far or that you're.
are you going to actually answer some of like the, oh, I have assumptions? Are you going to say, expand on your stuff?
I am. Do
Okay.
you want me to first?
No, I'm going to call in a lifeline again here. Lifeline number 2. What do you think the biggest focuses are for IMBs? And like, why are people at
Why
this
go to the
open?
conference?
Why go to the conference?
Well, I've been asking them that, and most of the answers I hear are to meet the usual, meet with existing clients, meet with potential clients, meet with vendors, current vendors, meet with potential vendors, and just say hi after not attending a conference through, October, November, December, and most of January, just to say hi again. The I would say that there's not. This is going to sound cynical again, but I wouldn't. I would say there's not a lot of tremendous things, new things out there per se, but it is good to kind of hear like, oh, here's our plans for 2025. Here's what we're gonna be rolling out in 6 weeks or 6 months or whatever it is, because there are some things going on. But I think it's just more to kind of touch base with people. But I will say that the lobby of the hotel this morning was packed with people actually having business meetings. So there is business to be had, but I think much of it is touching base and saying hi, how you doing? How were your holidays, kind of thing.
Yeah, I think that reconnection makes sense. I think, I talked to some IMB executives, Robbie, who do like to have others in the industry that they can pick up the phone and call. What are you seeing? What are you hearing? I think the national lenders tend to compete in a way that wouldn't allow them to do that. So the top 10, et cetera. But I think especially if you're a regional IMB, you have another regional IMB, you're not in the same region, being able to call each other and ask those questions, I think is good. It's important. The second thing, though, that you asked me to respond to or think about is what I think the biggest issue is. And the biggest issue for me is GSE footprint. I think that everybody's a little too comfortable that it's going to be a reasonable transition to exit. I think the exit is the IPO we've been hearing about. There will be private capital coming in to buy shares, taking Fannie and Freddie private with, government-backed guarantees. But I think we got way too comfortable with like, it'll probably be methodical and reasonable. I think it's going to be swift, and I think it's going to be really dramatic. And dramatic, not in the sense of like social drama or political drama, just in the sense of like, we're doing this, it's a singular goal, and all roads lead to exit. And that's going to cause the loan production box, the rate sheet, the subsidies, the LLPAs to all reflect that sooner rather than later. And that's my prediction. Again, best predictions go wrong, but that will be where I think.
Well, they say if you're gonna predict something, don't put a time on it, and if you're gonna try and time something, this.
Yeah, I got you. I think everybody got it. Yeah.
Could that lead to better home affordability in any way if we see rates start to shoot up? Will that push home prices down? Is there any?
I don't think it'll.
Silver lining.
I know what you mean. I don't think it'll push home prices down far enough to matter to get to attainable or affordable relative to the demand and the global capital that could come in and buy those up. So, for instance, the places that people want to live and are waiting for homes to become more affordable, probably a lot of metro areas in Texas, maybe even Metro Austin is a great example. There's a bunch of others that even if rates go so high as to depress home prices, it won't depress them far enough to reach millennials, to reach first-time home buyers, to reach affordability for a GSE client, a GSE first-time home buyer client. So I think what's going to happen instead is that home equity is going to become incredibly valuable and get increasingly valuable. So it's 35 trillion now. It's going to become even more valuable. And we are just going to kind of force the market through this to get to the other side.
I am hearing some chatter out there about companies starting to jockey to replace Fannie and Freddie once they do get private capital back in or they're released from conservatorship. So you're making out to kind of be this like cliff though. Day one of them, going back into being private, off the cliff we go. Do you feel like it's this stark like a?
Well, when I say off a cliff, what I mean is the players who want to come in and challenge them don't want to come in and challenge them at the rate of return that they currently exist at and probably will command as they exit. The new shareholders have an incentive for higher rates because they know demand is out there and they know home availability is limited. So new GSE shareholders are going to say, don't lower the rates, keep them the same or increase them. Higher they go, the more likely it is private capital wants that rate of return, right? So it gets a lot more interesting for private capital at 8, 9, 10%, because that's what they can get elsewhere. And so suddenly it's safer and they'll come in. But to me, an exit from conservatorship does not lower rates at all. In fact, I think it holds them and makes them higher relative to the new shareholders.
That's a pretty logical takeaway from it. I'm hearing here, non-QM is always there's some chatter about it going on.
Sure.
Yields on non-QM right now are very appealing to investors, and so they're at a point where 7%, 8%, whatever it is, that investors like the credit risk profile of these borrowers, they want more. And then, so the demand is out there in the secondary market for non-QM. I wonder, say Fannie and Freddie get privatized, rates go up a little bit. How, if we're going to reach this nice balance of a bunch of money will start flowing in to the mortgage-backed security market because borrowers now are much more credit worthy than they were 15, 18, 20 years ago. And the yields are at a great level. And it's appealing for companies to start putting money into that. It'd be interesting to see. I'm a larger elephant in the room than Fannie and Freddie, is what's the Fed going to do with its balance? I think that has as much of an impact on rates as Fannie and Freddie in a lot of ways. Is the Fed going to start engaging in active sales? I don't know about that. Could there be something that would cause the Fed to start to buy mortgage-backed securities again if rates get to a certain level? There's some chatter.
How much pressure? I think another way to put that: how much pressure would the White House have to put on the Fed to get them to start buying those bonds again, just to get rates to go down? I mean, that's one way to do it. How much pressure would they have to put in order for that to happen? And then obviously if it happened, rates would likely go down. Right now, so we got a question in the chat, Robbie. The
love an anonymous attendee.
That's an anonymous attendee. Yeah. With the government guarantee provides for a AAA rating on these MBS. The rating agencies are very critical in the non-QM space that you're talking about, rating those bonds and how those bonds are constructed. And the existing book then gets rated for those holding RMBS. What happens to the AAA bond without a government guarantee, or if that government guarantee gets a little bit more uncertain in the exit of conservatorship? So maybe that's a good question for this conference. You can take that to some of the meetings you have, get feedback.
You want me to answer it?
No, I'm leading up to the question. I'm just saying, don't forget to ask everybody while you're there. But what do you think? What do you think the sort of combination of the guarantee and the rating agencies does for our industry? It's been a slow move to get non-QM to inch up to be more trustworthy. What's the likelihood that happens in an exit?
So, I don't think the government guarantee going away is going to change the payment propensity of the borrowers out there. So I don't know if the borrower.
So those stay strong. Yeah.
So those stay whatever. My thought would be, and you're a baseball guy to probably a little larger extent than I am. I'm a baseball guy. It used to be that if you hit 300, you're an all-star. That was the AAA. No, not AAA, like
AAA rating. Yeah.
Of a player. Now you look at it, I think that what it means to be a AAA player has shifted. You can hit 268, but if you have a lot of home runs and RBIs and your slugging is off the charts, then you're still a AAA player. You're still an all-star. So I think these things are fluid, and there will always be AAA ratings, and they're and so it'll be what characteristics then evolve to be able to fit those tranches in the eyes of the rating agencies. I don't know. You don't look like you fully agree with what I'm saying, but
I am so tempted to get pulled into the philosophical macro analysis because that's where I like to live. So the look you saw on my face was actually me saying to myself, should we go there? Because everything in markets is relative, right? Relative to supply and demand. And everything you just described to me says the credit risk, the availability of return is all relative to what else can I do with my money and what is the risk and return on that money. The reason private capital hasn't come in to compete with the GSEs is because I don't want to do what I have to do to get a 4% return on that bond. But if it's a 10% return, now the stuff I was getting 9, 10, 11% on, it's safer over here to do mortgages at 9. Now that arbitrage makes sense to me. So I would say the government guarantee is really a question A of how they structure this exit, obviously, but then B, what else can I do with my money and how safe is it? And the riskiness of the borrower, the riskiness of the homeowner is all relative. And so if the whole market gets riskier, then you still are going to lend to the, ability to repay cohort that represents the top, I think in this case, 60% of Americans.
I don't want to sound like a curmudgeon here, but I will.
Okay.
A 7% mortgage rate historically is not a bad mortgage rate. And so we're just, I like that as time progresses, we're getting over this recency bias or FOMO of my friend got a sub 4%, my friend got a sub 3% rate. I don't want a 6% rate. I don't want 7%. Historically speaking, if you get a rate under 7%, you're doing just fine when it comes to a mortgage.
My point is that that's what your dad and Rob's generation tells us. That's what Rob's generation tells us. But what we know to be true is it's all relative, what I just said, and we only know what we know. So millennial homebuyers don't know what it was like to be employed with a W-2 salary and buy a house as a young dad in 1983. All they know is what it's like to have student loans, have a job that probably requires a side hustle, and to assume that home ownership is irrelevant to me because look at everything else I have to do, want to do, and need to pay for. So they don't give a shit that it was a 14% mortgage in 87.
Jeremy,
They weren't.
I'm gonna have to change the YouTube video now to say it's explicit and it's not for kids. Thank you for swearing for our live audience.
I always say it's not for kids, but I apologize for the profanity. I'll find a way to beep it out, maybe.
Well, hey, we can kind of tease this mortgage life here. You mentioned what was your side hustle out of college? What's your side hustle now? How are you making money outside of mortgage?
I definitely catered weddings when I was in law school. Now I didn't have a job and a side. I had law school full time and I catered weddings. I have always been fortunate to write, speak, advise companies and sit on boards. So that's what I would say.
Oh.
I like writing.
Internet currently, actually, but yeah.
Yeah. So, okay, let's wrap this up with a little bit more practical, seriously, with a little bit more practical takeaway. I think a lot of the volatility and uncertainty that I bring to the perspective.
Jeremy, all you're bringing on this Monday is a lot of seriousness. What, you cranky this morning? What's going on?
I don't think I'm cranky. I think
actually I had a lot of guava lemonade. I am on a sugar high right now, so I apologize for the
industry is meeting to ostensibly say, what is the outlook? What can we do? Our trade association is saying, here's what we're going to do for you in the next year. And what I'm saying is I want it to be helpful. I want that work to be valuable work. It sounds to me like there isn't much. If we take some of the things, the assumptions and the theories that we're throwing around here, there isn't much an IMB can do, honestly, given the uncertainty. They don't know what's going to happen with the political environment. They don't know what happens with the regulatory environment. They don't know what's going to happen with the rate environment. So what I'm saying is isn't this what the trade association is for? Get out there and do it. It's going to be great.
Yeah,
we're going to find out the answers.
I heard a good quote one time, not to go too philosophical here, but to people that worry, and if IMBs are worried about this upcoming year, that sort of thing, is it out of your control? Okay, well then don't worry about it. Is it in your control? Okay, well then don't worry about it. Control what you can control and don't worry about the things you can't control. Rates are going to do what they're going to do. They're the same for everybody out there. People are dealing with the same problems. Figure out your niche. What I've heard recently is companies that have figured out a niche for themselves and are able to focus on a specific area of lending. Maybe that's reno loans. Maybe it's doing a certain non-QM product. Maybe it's a buy before you sell product. Who knows what it is? Companies that have focused on that and actually started to get away from leaning on Fannie and Freddie for their pricing have been the ones that have been the most profitable of late.
Yeah. So get specialized. Actually, I think the step one is actually know what you're good at and know what you're capable of, then use that to get specialized. I think a big part of these conferences, and I think a big part of Now Next Later is, and then partner with the right people who can make that a reality, who also understand it and can make that a reality, and then go execute on that. And you won't have to necessarily worry about some of these other things, even though you'll have to pay attention to pivot if needed. But if you know yourself, you choose that specialty and you partner with the right people to make it possible. We just keep beating that drum of consistency because I think this is what we would all agree with. You, me, your dad, everyone at the conference. Consistency is actually a differentiator in this industry. If you stay consistent, that is really important. So
that's
thank
part
you
of our
for that.
that's part of our Chrisman brand. Consistency every day at 8:30 Eastern, commentary comes out every Monday, 10 a.m. Pacific, 1 p.m. Eastern. Now Next Later is here. Consistency, consistency, consistency.
What a great way to end it. Enjoy the conference. We'll look for your feedback in the commentary as you go through these hallway conversations and as you and your dad hear everything. And thank you everyone for joining us. Thank you, Silk Title. And we'll be back next week with another episode. Now Next Later.